Lock your screen, silence your phone, shut down every distraction. Because what I'm about to lay out will change the way you look at the silver market forever. All right, calm tone here. What you're watching right now is pure carnage. Silver is trading around 98.46 an ounce. Gold is sitting near 5,020.50. Silver has been slammed. Gold has taken a brutal hit. While most of America was asleep, the dollar weapon fired again. And this time it bulldozed everything in its path. Silver is down more than 14%. Gold is down over 6%. Platinum is crushed. Palladium is wrecked. This isn't a normal pullback. This isn't a healthy dip. This is a liquidation event. And if you don't understand why this happened while you were sleeping, you will get wiped out again when the next wave hits. The move you're celebrating is the decoy. Because the real fight, the one that decides whether you survive the next 30 days, is happening somewhere most retail traders never even look. And while you're staring at silver trying to bounce, a hidden weapon just fired. In the last 24 hours, we watched multiple trillions evaporate out of global markets as silver dumped hard, bounced briefly, and then collapsed again, while gold followed with violent downside pressure before attempting a weak recovery. Most traders believed the worst was over, convinced they had survived the storm. But that assumption proved catastrophically wrong, because while America slept and New York was closed, the Asian session opened and the dollar weapon fired again. Silver collapsed nearly 20% overnight. Gold absorbed another heavy blow, and anyone holding leverage, stop losses, or blind faith in psychological price floors didn't just take damage, they were wiped out. Positions were liquidated automatically while traders slept. Margin calls executed without mercy, and accounts were erased at the worst possible prices. All while the majority of participants had no idea why it was happening because they were staring at the wrong chart and tracking the wrong variable. Their fate was being dictated by 3 letters, DXY, the dollar index, not by silver's candles, not by inflation headlines, not by industrial demand narratives. Gold and silver are priced in dollars, and when the dollar strengthens against major currencies, it mechanically forces precious metals lower, not as a theory or correlation, but as cause and effect. This is why professional money obsessively tracks the dollar in real time, because DXY is a leading indicator that often signals what metals will do before metals move. When the dollar surges, institutional algorithms automatically unload metals, triggering liquidation cascades that retail traders only notice after the damage is done, turning them into exit liquidity for smarter capital. That is the mechanism behind the crash, and it's why the sell-off was not random, not a black swan, and not the end of the bull market. Similar patterns have repeated multiple times recently. Violent dollar spikes creating panic and forced selling, followed by powerful recoveries once the dollar reverses. And the only variable that matters now is whether dollar strength continues or breaks. Federal Reserve hawkish signals, global risk aversion, and weakening international growth are all stacking to support the dollar in the short term. And as long as that pressure remains, metals can stay volatile and dangerous, especially for leveraged traders. Leverage doesn't just amplify gains, it accelerates destruction, and a sharp move against you doesn't hurt. It removes you from the game entirely, which is exactly what happened overnight as forced selling created the cascade that patient capital was waiting for. Those holding unleveraged exposure survived the storm, bruised but intact, while leveraged traders were shaken out at the bottom and unknowingly transferred their capital to institutions that understand this cycle. For those who bought near the highs, the mistake was timing, not thesis, because every major bull market is defined by savage corrections that feel terminal in the moment, but prove temporary in hindsight. The structural case for silver remains intact. Constrained supply, rising industrial demand, geopolitical pressure, and de-dollarization trends have not disappeared. Only short-term dollar strength has changed, and dollar strength has never been permanent. What determines the next move is not hope or fear, but the behavior of DXY, shifts in policy tone, changes in risk appetite, and global growth signals. Those who panic and sell into fear repeat the same mistake every cycle, while those who understand the mechanism accumulate during chaos and position themselves for the reversal. Because when the dollar finally weakens and the weapon misfires, metals don't crawl higher, they explode, and only those who stayed solvent, patient, and prepared will still be standing to benefit from the move that follows.